Welcome back to the show. It gives me great pleasure to reintroduce Morty Korb, the Managing Director for Traders Leadership Council. Morty, how the devil are you, sir?
I'm very good. Thanks for having me back.
Well, we haven't seen you for a while. Traders Leadership Council, TLC, Tender Loving Care for short, I guess. What do they do?
Well, we help traders to make their strategies more robust. We work with traders on their trading psychology, and we do that through coaching and seminars and webinars for the last couple of years. So again, going very strong and helping a lot of traders in UK and in Europe.
Excellent. Well, you've sent a number of slides today. Perhaps we could go through these and, well, basically tell me what your thoughts are.
Sure, very happy to walk you through just 5 slides.
Okay.
So 2 questions come up again and again. One is a question: how much performance does my trading strategy need to deliver to pay for commission, transaction costs, spread, and all these things? And the other question you get even more is: does it make sense to use stop losses? And what's the impact of a stop loss on my strategy, or should I just get rid of stop losses all along? And we teamed up with some professors of a university in Germany, actually in Kaiserslautern, and we established 2 strategies, or it's one strategy, and we ran through 2 scenarios to get to very clear mathematical sound answers to both of these questions.
Right.
So what you see on slide 1 is we call it the monkey strategy. So it's a very basic 50% win and loss ratio strategy. So the theory is that the monkey has a trading account of £100,000.
Yep.
The monkey gets up every morning, and with a 50% probability, he decides to go long or he goes short. Right?
Okay.
And no money management, nothing involved. So really very, very basic strategy. We tested that over a time period of more than 2 years and used the DAX 30 as the financial instrument to test it, right? So what we've done then, if you go 1 slide further, you will see kind of one scenario that we went through. You can see the time scale from 2009 to 2011, and this kind of first instant, we actually lost using that strategy about 27% in that account that started with £100,000 and landed on 73. Yeah.
So that's basically a 50-50, heads or tails.
Exactly.
No stop losses. A monkey trade.
A monkey trade, absolutely.
Okay.
And what's important for traders who want to improve their trading is that you should not just look at one scenario. You have to look at many scenarios to understand what's really happening in your trading strategy.
Okay.
So we ran that a second time, and in this case, exactly the same strategy, but the kind of market environment was, or like the decision process in the morning. The market environment was the same. The monkey made a different decision in the morning. Again, 50-50. He would go long or short. In this case, he got it better. So he made 24.8%, ending with 124,800. And when we did it again and again and again, in total we did it 100 times. And when we looked mathematically at the output, and that's when you trade, that's the level when you can draw some conclusions, right? And that's when you can think about the impact on your strategy or learn something from it. So what you see here, it looks a little bit difficult, but it is not at all. On the right-hand side, you see the distribution of these 100 runs we had, the same strategy 100 times. And you see on the left-hand side, sometimes it got as low as 60,000.
Yep.
And sometimes it got even above 130,000. But you see that aggregation towards the middle, and that's the expected value that we kind of put on the top. The expected value of that is 90,000 of that strategy. And we also introduced another number. It's called the variance. Variance is nothing else than the drawdown you would expect in that set of strategies over.
So that would be your maximum drawdown or your average drawdown?
That would be the average drawdown. Okay. So in that case, it's 18,500 or 18.5%. Quite interesting. Nobody likes losing, but in order even for this simple strategy to be successful or to come to the end, you need to accept that you can go as low as 18.5% drawdown. But the key learning here on this slide really is that the expected value is clearly below 100,000.
Yep.
So that's about 10. Well, very clear. It's 10% on average.
On average, you lose 10% of your money on a heads or tails.
Exactly. And because it's such a balanced 50-50 strategy, the 10% really represents the spread, the slippage, the requotes, the commission, if you have a broker that uses commission. So that is very, very sound calculation of over 2.5 years.
So the broker's happy, the trader's unhappy.
Yeah. So that's a 10% over 2.5 years. If you annualize that, you come, you arrive at something around 4% per annum. So your trading strategy over a year needs to perform and it needs to give you a 4% return on investment to pay for all the transaction costs, which is quite considerable. And a lot of traders overlook that. And obviously that can make the difference between a successful strategy and an unsuccessful one.
Understood. Okay, so let's have a look at the next slide, scenario 2. This is where it gets interesting.
Yeah, exactly. Scenario 2. So transaction costs, we ticked that one off. It costs money and it's about 4%. Secondly, we looked at the exact same strategy, and we just implemented a very simple money management rule. You can see we put in a stop loss at 50 points and we put in a take profit at 150 points.
And this is still on the same contract, the DAX, over the same period.
Exactly the same scenario, and we ran it 100 times. And just here would say we only allow kind of one risk element equaling 50 points on the stop loss side and 3 reward elements on the take profit side.
I.e. every textbook in the world would say that's the way to trade, not scenario 1.
Yes, but a lot of traders still doubt it. A lot of traders intuitively say, like, I get stopped out by the broker, and then if I would have just had no stop loss and moved it 10 pips further, my strategy would have performed better. So we looked at it completely unbiased with a mathematical way, again running it 100 times, and let's have a look at the result. So you see, 2 values have changed. So if you just look at the graphical representation, we eliminated the 60,000. So we had no scenario where we went down as low as 60,000, but we also reduced the amounts of big winners where we got above 130,000. So we pushed it together more in the middle and slightly to the right.
To the right, yep.
So the expected value over the 100 simulations moved up from 90,000 now to slightly above 100,000. And what we would argue is more importantly, the risk element moved from 18,500 down to 13,900. So again, over that 2.5-year period, you would now not expect a maximum drawdown of 18.5%. but a maximum drawdown of close to 14%. And that for us was a very kind of sound mathematical way to say it does make sense to religiously use stop losses and take profit, because they can have, if you use them the right way, they can have a positive impact on the risk that you're running in your strategy. And in this case, also the expected value goes to the upside. But let me be clear, I'm not telling you that you will, in all cases, make money with it.
You can still
exactly, but on aggregate, and that's what we want to do. We want to make our strategies more robust, and that's what we do at the Traders Leadership Council. We help traders to adopt that kind of mindset to become hopefully sustainably successful in the capital markets.
Well, it's quite clear that if you risk 1 to make 3, you've got a better chance in the markets than going 50-50.
Exactly, and it doesn't work when you start moving your stop loss, then it doesn't work anymore.
Understood. Multicorp, Managing Director, Traders with an S, Leadership Council, TLC. Thank you for giving some tender loving care to the Tip TV crowd. Thank you for that.
Thank you.
Let's take a very quick break and then we'll be straight back. Thank you.